Welcome to Wealth Hustle 247 podcast, your trusted guide to financial literacy, business innovation, and entrepreneurial success. Learn how to grow your wealth, make informed decisions, and turn your ideas into profitable ventures.
Curious about real estate without the hassle of owning property? In this episode, we dive into investing in REITs, a comprehensive guide, everything you need to know to get started. Let's unpack it.
Hey everyone, and welcome to this deep dive into REITs. You might be kind of curious about real estate investing, or maybe you're thinking about a big financial move. Well, either way, we're here to unpack REITs just for you. So, what exactly are REITs?
Well, they're companies that own or operate, or sometimes finance, income-producing real estate.
Okay, so think of it like this. Instead of buying stock in one single company, you're investing in a whole bunch of properties.
What's interesting is that with REITs, you can get into real estate without those headaches you hear about, No having to fix leaky faucets or deal with tenants yourself. Plus, you have the potential for regular income through dividends, and it's more diverse than just owning one property.
All right, let's break this down a bit more. Imagine we're at a giant real estate fair. There's a booth for every kind of property you can imagine.
Sounds fun.
Right, that's kind of what REITs are like. We can sort them in a couple of ways.
Right.
Starting with the types of assets they own.
Yeah, the first booth you'd probably see is for equity REITs. These are the most common type. And they own and operate the properties themselves. They make money from the rent and also from, if the property value goes up.
So it's like getting a piece of the real estate pie without having to bake the whole thing yourself.
Exactly.
And within equity REITs, there are all sorts of different types, like flavors of ice cream.
Yeah.
For starters, you've got residential REITs.
Yeah, these REITs invest in properties where people actually live.
Right. Think apartment complexes, neighborhoods with single-family homes, and even student housing.
Even manufactured home communities fall under this umbrella.
It's pretty amazing how diverse just this one category is.
It really is.
Then there's office REITs.
Those invest in those big skyscrapers you see in cities, but also smaller office parks in the suburbs.
Right, and with how work is changing, office REITs are having to, adapt. Some are focusing on super nice locations with great amenities to attract tenants. Others are trying out flexible workspaces or even converting older buildings into apartments.
That's an interesting point. So even within one REIT category, you have to think about how they're reacting to what's happening in the world.
Yeah. Speaking of changing trends, let's move on to retail REITs.
These REITs own everything from those big malls we all know to outlet centers and even individual stores you see on the street.
It's really the whole spectrum of retail.
Yeah, but this is a sector that's really been challenged by, online shopping. So the successful retail REITs are having to get creative and find ways to make their properties into destinations that offer more than just shopping.
Right, like with entertainment and restaurants, they're becoming places where you want to hang out.
Exactly.
Now, let's head over to a booth that's not as glamorous, but still super important. Industrial REITs.
These are really the backbone of how our economy works. They invest in warehouses, distribution centers, all that behind-the-scenes infrastructure that makes manufacturing and e-commerce work.
It's they're the ones making sure everything gets to where it needs to go.
Right. And with more people shopping online, industrial REITs are becoming more and more in demand.
Okay, let's take a break from logistics and head over to something a little more relaxing. Hospitality REITs.
Ah, yes. These REITs invest in hotels, resorts, anything that offers a place to stay when you're traveling.
And this sector, I imagine, was hit pretty hard during the pandemic, right?
Yeah, definitely. But now, as travel is picking back up, there's potential for them to make a comeback.
It makes sense, after all. Who doesn't love a good vacation?
Yeah.
But the success of hospitality REITs, I guess, relies heavily on travel trends, tourism, and things like business travel picking back up.
Exactly. It shows how the success of different REIT types is often linked to broader trends in the economy and society as a whole.
Speaking of essential services, let's talk about healthcare REITs.
Okay, sure.
Healthcare is always in demand, no matter what's happening with the economy. So I'd imagine healthcare REITs are seen as a pretty stable investment, right?
Yeah, that's generally the case. They invest in things like hospitals, nursing facilities, and medical office buildings. Those services are needed no matter what the economy is doing.
So they're like a safe haven, attractive for investors who want a more stable income stream.
Right.
Now, the last booth, I think, is the most interesting one, Specialized REITs.
Oh, yes. This is where things get kind of unique.
So what exactly falls under specialized?
Specialized REITs invest in things that don't really fit in those other categories we talked about. We're talking data centers, the powerhouses of the digital world, self-storage facilities, timberlands, even things like cell towers and renewable energy projects.
Wow, that's a really wide range. It seems like there's a specialized REIT for just about everything. What's driving the growth in this category?
It's a few things, really. We live in a digital age, so there's a huge demand for data centers. The rise of online shopping means more warehouses, which helps industrial REITs, but also self-storage because people have more stuff. And then with more focus on climate change, there's a growing interest in REITs that invest in renewable energy projects.
It sounds like specialized REITs are investing in the future.
In a way, yeah.
We've covered a lot about equity REITs, but that's just one type. There are also mortgage REITs, or MREITs.
Unlike equity REITs, which own properties, MREITs provide financing for real estate.
So they deal with mortgages and mortgage-backed securities, essentially acting as lenders in the real estate market.
Exactly.
So instead of directly collecting rent from tenants, MREITs earn money from the interest on the loans they provide. It's like being the bank.
That's a good way to put it. But it's worth noting that MREITs are more sensitive to changes in interest rates and credit risk compared to equity REITs. So higher potential returns, but also higher risk.
So it's a higher stakes game with MREITs. And just for clarity, what are mortgage-backed securities?
Okay, imagine you take a bunch of individual mortgages and bundle them together. These bundles are sold to investors, and those are mortgage-backed securities. It's a way to diversify your investments, but they can be complex, and there are risks involved.
Okay, so it's like buying a mixed bag of candy. You don't know exactly what you're going to get.
That's one way to put it.
Now, for those who like a bit of everything, there are also hybrid REITs.
As the name suggests, hybrid REITs invest in both properties and mortgages. It's kind of a best of both worlds approach, aiming for both income and growth.
Like having your cake and eating it too. Or maybe diversifying within the REIT world itself. So far, we've talked about different types of REITs based on what assets they own, but we can also categorize them by their structure, how they operate.
Right. Think of it like choosing how you want to buy ice cream. Single scoop, pre-packed pint, a whole custom-made tub.
I like that analogy.
Yeah.
So there are publicly traded REITs, public non-traded REITs, and private REITs.
Publicly traded REITs are like buying stocks on the stock market. You can buy and sell them easily.
So for investors who value flexibility, that's a good option.
Exactly. And because they're publicly traded, they have to follow all the regulations, which provides some protection for investors.
Okay, what about public non-traded REITs?
These are registered, but they're not on the stock exchange, so it's harder to sell them quickly.
So less flexible, but maybe higher potential income.
Right.
And finally, private REITs.
These are not for the average investor. They're usually only for big institutions or very wealthy individuals. They offer high potential returns, but it's very difficult to get your money out quickly.
Okay, so we've gone through the whole world of REITs, from the different kinds of equity REITs to mortgage REITs and the different ways they operate.
It's a lot to take in.
It is. But before you run off to invest in every REIT you can find, let's talk about some things you need to consider.
Right. We're not giving specific financial advice here, but we want to give you the knowledge so you can make good choices for your own goals and how much risk you're comfortable with.
It's like giving you the tools and the map to navigate this whole world of REITs.
I like that. And the most important thing is to understand yourself as an investor.
Like choosing your own adventure. Different REITs are good for different goals.
Exactly. If you want a steady income, you might look for equity REITs that have a good track record of paying dividends. But if you're looking for long-term growth and are okay with more risk, you might look at REITs in sectors that are growing fast, like technology or renewable energy.
And of course, you have to think about your risk tolerance. Can you handle the ups and downs of the market, or do you prefer a smoother ride?
Right. It's important to align your investments with your comfort level.
So know yourself as an investor and choose REITs that match.
I agree.
Once you know what kind of investor you are, it's time to look closely at individual REITs.
Yeah, don't just look at the name and think you know everything. It's time to peek inside that portfolio.
Okay, so what are we looking for? What's important when you look inside a REIT's portfolio?
You want to see what kinds of properties they own, where they are, and who's renting them. It's all about diversification, understanding what sectors the REIT is invested in.
So, for example, if a REIT mostly owns shopping malls when online shopping is booming, that might be a red flag.
Yeah.
But if they own a bunch of warehouses that are rented to big online retailers, that could be a good sign.
Right. It's about connecting the dots, seeing the bigger picture. REITs don't exist in a vacuum.
Right. They're affected by what's happening in the economy and in specific industries.
Exactly.
So it's like being a detective trying to understand the whole story behind the REIT.
Exactly. And now let's move on to the numbers. Those can help you figure out how much you might earn back from your investment. We'll start with dividend yield.
That's a big reason why people invest in REITs, right? The potential for regular income.
Exactly. But think of dividend yield like the interest rate you're getting on your investment.
But it's not the whole story,
Yeah.
right? We also need to look at the payout ratio.
Right. That tells you how much of a REIT's profit they're paying out to investors as dividends compared to how much they're keeping to reinvest for future growth.
So a high payout ratio might mean more money in your pocket right now, but it could also mean that the REIT has less room to grow in the future.
Yeah, it's a bit of a balance. High payout ratios are good for people who want income now, but maybe not so much for people who are focused on long-term growth.
So dividend yield and payout ratio give us insight into the income potential, but we also need to assess the REIT's overall financial health.
Yeah, it's like giving the REIT a financial checkup. You want to make sure it's in good shape. We have funds from operations, or FFO, net asset value, or NAV, and the debt to equity ratio.
Okay, that sounds a little technical. Can you break those down for us? What are FFO and NAV, and why are they important?
FFO is basically the REIT's paycheck. It's the cash flow from its operations, or how much money is coming in after covering its costs. It tells you how well the REIT can pay dividends and take care of its properties.
So it's a more accurate picture of how well the REIT is doing financially than just looking at its overall revenue.
Exactly. Then you have NAV, which represents the REIT's worth. It's calculated by taking the market value of its assets and subtracting its liabilities.
So it's basically an assessment of the REIT's underlying value, like if you were to sell all its assets and pay off all its debts.
Right. And last, we have the debt to equity ratio, which tells you how much debt the REIT has compared to its equity.
So a high debt to equity ratio can mean higher returns, but it can also be riskier, especially if interest rates go up or the economy takes a downturn.
Right. It's about finding a balance. And remember, REITs don't operate in a vacuum. They're affected by everything that's happening in the economy and the markets.
Right, like interest rates, inflation, economic growth, and what's happening in specific industries, those all play a role in how REITs perform.
It's like sailing a ship. You have to be aware of the winds and the currents.
I like that analogy. And speaking of sailing, sometimes seas can get rough. What risks do investors need to be aware of when it comes to REITs?
Okay, so we've mentioned interest rate risk and economic risk, but there's also market risk.
Right, just like any investment on the stock market, REIT prices can fluctuate even if the underlying properties are doing well.
Yeah, and then there's tenant risk. If a big tenant moves out of a property, it can take time to find a new one, and the REIT loses income in the meantime.
So it's like owning a rental property where the tenant suddenly moves out.
Exactly. And then there's liquidity risk. Publicly traded REITs are generally pretty easy to buy and sell, but public non-traded REITs and private REITs are not as easy to sell quickly.
So if you might need access to your money quickly, publicly traded REITs are probably the better choice.
I would agree. Now, let's move to a topic that isn't as fun, but just as important: taxes.
Ugh, taxes.
I know.
But it's important to understand how they affect REIT investments.
Definitely. One thing to remember is that dividends from REITs are usually taxed as regular income. They don't get those lower tax rates that some dividends from regular stocks get.
But there can be some tax benefits with REITs too, right?
Yeah, for instance, REITs can pass on depreciation benefits to their investors.
Okay, so not all bad news on the tax front. Before we get too deep into analyzing specific REITs, let's take a step back and remember the people behind the scenes, the management team.
They're crucial. The management team can make or break a REIT like the captain of a ship.
So look at their track record. Have they made good investment decisions in the past? Do they have a clear strategy? Are they good at adapting to changes?
All good questions to ask.
It's like choosing a CEO for your own personal real estate empire.
Exactly. And lastly, we can't forget fees and expenses.
Ah, yes, those sneaky costs that can take away from your profits.
Right. And with REITs, these fees can come in different forms.
Listen.
Okay, for example, there are acquisition fees, which are charged when the REIT buys new properties. Then you have management fees, which go to the company that's actually managing the REIT's investments.
You're paying someone to manage your investments. Not ideal.
And don't forget brokerage commissions. These can vary a lot, so it's important to compare them.
That's like comparison shopping for your investments.
Yeah.
Makes sense. And one more thing, especially with those non-traded REITs, be careful of hidden fees and penalties for selling your shares early.
Yes, transparency is key.
Okay, I think we've given everyone a lot to think about in this first part of our REIT deep dive. We've covered the different types of REITs, what to consider before investing, and the potential risks.
It has been a whirlwind tour.
It has.
Welcome back to our deep dive into REITs, ready to explore this fascinating world even more.
You bet. Last time we left off with a question. What are some of the downsides investors need to know about REITs?
Exactly. It's all good to talk about how much money you can make, but smart investors need to know the risks too.
Right, it's like if you're planning a hike. You want to know if there are any tough parts of the trail, not just about the view from the top.
Great analogy. And one of the biggest risks with REITs is that they can be really affected by changes in interest rates. Lots of REITs, especially those buying or developing properties, borrow money to do business.
Yeah, real estate needs a lot of money up front. So REITs use debt, like loans, to make their investments work harder. But how do rising interest rates affect them?
Well, when interest rates go up, the REITs have to pay more to borrow money, so their profits can go down, and it gets more expensive to buy new properties or even refinance their existing loans. They might even have to sell some properties to pay off debt.
So it's like hiking uphill with a heavy backpack. Gets harder, and you might have to lighten your load to reach the top. But wouldn't lower interest rates be a good thing then?
In theory, yeah. Lower rates usually mean cheaper borrowing, so REITs can make more profit and maybe buy even more properties, like a sudden burst of energy on your hike.
Makes sense. So it's tricky for REITs. They need to be careful with how much they borrow and keep an eye on interest rates.
Exactly. And it's not just about interest rates. REITs are connected to the real estate market, which means they're also affected by the ups and downs of the economy.
That makes sense. When the economy is good, people have more money, businesses are growing, and everyone wants real estate. So that's good for REITs.
Right. More people renting their properties, higher rents, and property values going up. It's a good cycle. But what happens when the economy slows down, like during a recession?
Things get a bit tougher, I imagine. Businesses might close, people might lose jobs, meaning empty offices and shops. That can push rent prices down and lower property values, hurting the REIT's profits.
That's right. And REITs that focus on certain types of properties, like hotels or shopping centers, feel the effects more than those invested in, say, healthcare buildings or apartments. It's like choosing a strong boat to weather a storm.
So having a mix of different types of properties in their portfolio can help REITs handle those tough times.
Exactly. You want to spread the risk because different sectors of the economy react differently. A good REIT portfolio would have residential, industrial, healthcare, maybe even some of those specialized REITs we talked about.
Makes sense. Like a balanced diet.
Exactly. Now, moving on, let's talk about another risk for certain REITs. Oversupply. Have you heard of that?
I think so, but can you explain it?
Sure. Imagine everyone starts building hotels in a city expecting lots of tourists, but then, for whatever reason, the tourists don't come.
Uh-oh. Too many hotels and not enough guests. Bad news for the hotel REITs.
Right. Too much supply in any part of real estate means lower occupancy rates. REITs have to lower their rents to attract tenants, and that hurts their profits. It's a race to the bottom.
So even with something as stable as real estate, there's risk if there's too much building.
Exactly. Now, let's tackle a question that I'm sure many investors are thinking about, especially after what happened back in 2008. Can REITs actually collapse?
Yeah, that makes sense. Back then, the whole housing market crashed and banks went down with it. Could the same thing happen to REITs?
Well, REITs can be affected by market downturns. The 2008 crisis showed problems, especially for mortgage REITs that were invested in risky loans. But it's important to know that REITs are regulated.
So there are rules they have to follow to protect investors.
Right. They're also required to pay out a large portion of their profits to shareholders as dividends. This can be a good thing. It reduces the temptation to make risky investments with those profits.
So those dividends make things more transparent and hold the REITs accountable to their investors.
Exactly. But let's be realistic. Any investment comes with some risk. Even with regulations and dividends, things can happen that are outside a REIT's control. Think about a pandemic, changes in laws, or even just how people's preferences change over time. These can all affect the real estate market and impact REITs.
So it's about being smart, choosing REITs with a good track record, and understanding those risks.
Yes, exactly. Making informed choices. And talking about informed choices, let's bring up something that's often overlooked: fees and expenses.
Oh yeah, those pesky fees. The hidden costs that eat into your returns.
It's true, REIT fees come in many forms. We talked about expense ratios before, which cover the REIT's operating costs, but there are other fees to watch out for.
Like what? Spill the beans.
Well, some REITs charge acquisition fees when they buy new properties, and there are management fees which go to the company managing the REIT's portfolio.
So it's like you're paying rent to the landlord of your investments.
Yeah.
Not exactly what we want.
Right, and don't forget those brokerage commissions when you buy or sell shares. Those can be all over the place, so you've got to compare.
It's like shopping for the best price on your investments. Makes sense.
Yeah.
And a warning, especially for non-traded REITs. Watch out for those hidden fees or penalties if you try to sell early.
Good point. Transparency is key. Before we finish this part of our REIT discussion, I want to emphasize one more thing. Make sure your REIT investments match your goals and how long you plan to invest.
Right. REITs aren't a one-size-fits-all thing. They're all different, with different risks and rewards.
Exactly. If your main goal is steady income, you might look at equity REITs that have a history of paying good dividends consistently. These are typically invested in things like apartment buildings or healthcare facilities where people are always going to need those services.
It's like having a steady stream of rent payments coming in, but without having to be a landlord yourself.
Perfect analogy. But if you're more interested in long-term growth and are okay with taking on more risk, you might consider REITs in sectors that are growing fast, like tech or renewable energy.
So it's like you're investing in those future trends.
Exactly. And how long you plan to invest is important too. If you're investing for retirement, you've got time to ride out any ups and downs in the market.
Like planting a tree. You've got to give it time to grow. But if you need your money sooner, REITs, especially those hard-to-sell ones, might not be the best choice.
I agree. Different goals need different strategies. Now, one last tip for everyone who's interested in REITs.
Okay, let's hear it.
Don't just rely on what the REIT companies themselves say. Look for independent information from reliable sources like financial publications or those rating agencies. They can give you an unbiased view.
So it's like getting a second opinion before you make a big decision.
Exactly. Remember, investing is a journey, not a one-time thing. It's about constantly learning, adapting to the market, and making choices that are right for you.
Well said. Welcome back to our final part on REITs. So we've talked about what REITs are, what to consider before investing, and the risks. Now let's get down to the nitty-gritty. How do you actually build a REIT portfolio that works for you?
That's the million-dollar question, isn't it? And there's no single right answer. It all depends on your own personal situation, your goals, your risk tolerance. But there are definitely some strategies we can talk about.
It's like we've got all the building blocks. Now it's time to put them together and build something like a house.
I like that. And just like building a house, you need a good plan and a solid foundation. Remember those two key principles we talked about?
Research and diversification.
Bingo. Those are super important for any investments, but especially for REITs.
Okay, so let's start with research. Any practical tips on how to actually research REITs?
Don't just rely on what you hear from other people or those fancy brochures. Take some time to really understand what the REIT invests in, what their properties are like, how healthy they are financially, and the experience of the management team.
It's like doing your homework before you buy something expensive.
Exactly. Look at those prospectuses, the annual reports, see what independent analysts are saying. It's like being a detective, putting the pieces together to get the full picture.
So don't just focus on the numbers, but also try to understand the REIT's overall strategy and who's running the show.
Right. You want a REIT with a clear vision, a good track record, and a management team that can handle whatever the market throws at them.
Makes sense. So once you've done your research and found some REITs that look good and seem like a good fit for your goals, that's where diversification comes in.
Exactly. You want to spread your risk. It's like putting together a winning team. Each player has their own strengths.
And with REITs, that means investing in different types of properties, right?
Right, you got it. Don't just invest in office REITs, for example, especially with so many people working remotely now.
Right, got to hedge your bets. A good REIT portfolio should have a mix of different property types. Residential, industrial, healthcare, maybe even some of those specialized REITs we talked about.
And remember, diversification goes beyond just REITs. Think about having other investments too, like stocks, bonds, even things like commodities. A diverse portfolio can handle those market ups and downs much better.
Right. It's like creating a whole financial ecosystem that can adapt and grow.
Exactly. And one more thing, remember that investing isn't something you do once and then forget about. It's ongoing. You need to keep an eye on things, make adjustments as needed.
It's like tending a garden. You have to water it, weed it, and keep it healthy.
Perfect analogy. Keep learning about the market, how the economy is doing, and anything that might affect your investments. Stay curious.
All right. I think that gives everyone a good starting point for exploring REITs. We've covered a lot in these three parts: what REITs are, the different types, things to think about before you invest, the risks, and now even some strategies for building your portfolio.
It's been quite the deep dive.
It has. We hope you enjoyed this exploration into the world of REITs, and now you feel a little more confident about navigating this exciting part of the investing world.
That's it for today's episode of Wealth Hustle 247. Be sure to follow, like, comment, and share with others. Keep pushing toward your goals, and we'll see you in the next episode.